Today, we will talk about Basel I, which is a set of international banking regulations. Basel I is a set of international banking regulations established by the Basel Committee on Banking Supervision. It prescribes minimum capital requirements for financial institutions, with the goal of minimizing credit risk. Under Basel I, banks that operate internationally were required to maintain at least a minimum amount of capital, 8%, based on their risk-weighted assets. Basel I is the first of three sets of regulations known individually as Basel I, II, and III, and collectively as the Basel Accords. The BCBS was founded in 1974 as an international forum where members could cooperate on banking supervision matters. The BCBS says it aims to enhance financial stability by improving supervisory know-how and the quality of banking supervision worldwide. This is done through regulations known as Accords. Basel I, the Committee's first accord, was issued in 1988 and focused mainly on credit risk by creating a classification system for bank assets. The BCBS regulations do not have legal force. Members are responsible for implementation in their home countries. Basel I was developed to mitigate risk to consumers, financial institutions, and the economy at large. Basel II, brought forth some years later, lessened the capital reserve requirements for banks. That came under some criticism, but because Basel II did not supersede Basel I, many banks continued to operate under the original Basel I framework, later supplemented by Basel III addendums. Perhaps the greatest legacy of Basel I was that it contributed to the ongoing adjustment of banking regulations and best practices, paving the way for further protective measures. Basel I has been criticized for hampering bank activity and slowing growth in the overall world economy by making less capital available for lending. Critics on the other side of that argument maintain that the Basel I reforms did not go far enough. Both Basel I and Basel II were faulted for their failure to avert the financial crisis and Great Recession of 2007 to 2009, events that became a catalyst for Basel III. The Basel I classification system groups a bank's assets into 5 risk categories, labeled with the percentages 0%, 10%, 20%, 50%, and 100%. The bank must maintain capital equal to at least 8% of its risk-weighted assets. Tier 1 capital is the most liquid type and represents the core funding of the bank, while Tier 2 capital includes less liquid hybrid capital instruments, loan loss and revaluation reserves, as well as undisclosed reserves. Here are 4 key takeaways. 1. Basel I, the first of 3 Basel Accords, created a set of rules for banks to follow to mitigate risk. 2. Basel I is now considered too limited in scope, but it laid the framework for the subsequent Basel Accords. 3. With the advent of Basel I, bank assets were classified according to their level of risk, and banks are required to maintain emergency capital based on that classification. 4. Under Basel I, banks were required to keep capital of at least 8% of their determined risk profile on hand. Hope this would help. Thanks for watching.